You're listening to Market Champions, a podcast on navigating the financial markets. Here's your host, Srivatsan Prakash.
This episode of Market Champions is brought to you by Simplify ETFs. For more information, visit simplify.us. No simplified funds will be discussed during this podcast. Hey guys, welcome back to another episode of Market Champions. I just wanted to remind you to like, subscribe, and leave a comment. Really helps the page grow, really helps the podcast grow. Thank you so much for your support. And now on to the interview.
Hey everyone, welcome back to another episode of Market Champions. Today I've got Michael Howell. Michael Howell is the founder of Cross Border Capital and the author of Capital Wars, a phenomenal book on liquidity. Michael, thank you so much for being on the podcast. It's a pleasure to have you on.
Great pleasure to be here. Thank you.
Awesome. Michael, just to sort of kickstart the podcast, I think one thing that we should start by talking about, and I noticed this a lot on say Twitter, other podcasts, etc., is that a lot of people have many misconceptions about the functionality of liquidity. And so, one of the views that I've seen espoused on places like Twitter is that, when the Fed or when other central banks add liquidity to a market through say QE, etc., one side says that look, the Federal Reserve is busy printing money, all the printed money is going into stocks, etc. Then the other side says that this is actually none of that is true. These are just reserves, which are not money. And this is sort of works through mostly the expectations channel rather than through physical money that gets spent on stocks, etc. Which one of these sides is right? I think that's sort of a good place to start.
Okay, well, I think the short answer is in some ways all of them are correct. I think what we need to do though is to define our terms pretty precisely. And the first thing to do is to distinguish between what we think of as market liquidity, which is a measure of the depth of a trading market. In other words, can you transact in size and can you transact around current prices? So measures such as the bid-ask spread, the volume that you can trade in are all measures of market liquidity. And that's how market participants normally think about liquidity from that standpoint. In other words, the depth of the market, how liquid it is from a market standpoint. But there's another definition which is in a way more important and comes before market liquidity, which is funding liquidity. And that is there the money, if you like, or the funding there to actually facilitate those transactions in the first place. And that's really where the central banks come in, or the banks or the shadow banks. They're the ones that are supplying this funding liquidity, and it's funding liquidity that moves market liquidity. Now, when we get onto funding liquidity, you've got to distinguish then about money. Let's think of it in terms of money, but let's distinguish money that is operating in the real economy, which is best measured by conventional metrics such as M1 or M2, and then measures that are of money that are circulating in the financial economy, which is what we think of as liquidity, which it doesn't have a nice aggregate letter or number like M7 or M6 or whatever it may be. It's basically a measure of that financial sector liquidity. That tends to be bigger than money in the real economy. It tends to be faster moving, and it's really what matters for asset prices. And that's what we follow.
Awesome. And so, just on that note, so when it comes to, thinking about, the two different kinds of liquidity, funding liquidity versus market liquidity, I wanted to start off by talking a bit about, this idea of funding liquidity. So, one thing that you mentioned was sort of how money in the real economy can be measured by M1 or M2. How accurate are those measures considering stuff like, for example, the quantity, for example, Milton Friedman is famous for saying that, the way to generate something along the lines of the way to generate money, inflation is by printing more money. And one thing that we have observed over, say, the post GFC era was the rising money supply, and we also saw falling velocity. So how true does that statement hold? Inflation is always and everywhere a monetary phenomenon. And then we can get to some of the we could dive deeper into some of the market funding dynamics.
Well, I think the answer to that is to put it a slightly different way and say that inflation is always and everywhere a real economy phenomenon. Okay, because what we think of as inflation is high street inflation, in other words, prices that are in shops or stores. That's the measure of inflation that people think of. And that basically comes down to money in the real economy. So if you're channeling more money into the real economy, creating more spending power and excess demand, you are likely to get inflation. In that regard, Friedman and the monetarists are absolutely bang on. You need to monitor these monetary aggregates because they're telling you whether you're going to get a surge of demand in the real economy. Hence, if you contrast two situations, one is immediately after the GFC, in the period from 2009, say maybe through 2012, what we saw was very aggressive activity from central banks. So central bank balance sheets increased significantly, but those monetary aggregates that we're talking about, M1 and M2, didn't really move very much. In other words, what that was telling us was that central banks are a source of liquidity primarily for the financial economy. They were putting money into financial markets. They were basically reloading the banks, improving the banks' balance sheets, if you like. But that money was not spilling out into the real economy and creating high street inflation. It was actually fueling asset price inflation. If you look at the situation following COVID, the COVID crisis, what happened then was that central bank balance sheets expanded, but they were largely accommodating government transfers. So essentially the furlough schemes, etc., were giving transfer payments to workers, for understandable reasons. That was fueling their bank accounts. M1 and M2, which are measures of that retail money, were rising. That was giving us a guide that there was tremendous demand being pent up in the real economies. And consequently, it's no great surprise that created high street inflation. How the central banks missed that or why they missed that is probably a long debate, but they did.
Yep. And so, on that note of asset price inflation, so could you, so sort of one part of the question is, could you talk about how, central bank liquidity actually funnels into asset prices? And two, and on a very similar note, what are sort of all the means of, that the Fed can use to provide liquidity to the market?
Okay, well, there are two questions and two answers. So let me give you the first one. How does the transmission mechanism work? The way that we think of it is that if what you've got is really two things that are working as the central bank expands its balance sheet. One is a portfolio balance effect, which is a sort of wonkish idea that basically says if the central bank is expanding its balance sheet, it is effectively buying assets in some way from the real economy, or it's creating liquidity by that means into the real economy. And it's forcing, let's say, pension funds or insurance funds or banks to hold more cash. It's maybe buying bonds or treasuries from them, forcing them to hold more cash and forcing them to make a portfolio reallocation decision because they don't want that excess cash. They want to put it to work. And so effectively what's happening, that process of central bank QE, if you like, is forcing investors along the risk curve. In other words, they're taking out semi-risk assets, they're replacing it with cash, and they're forcing investors to move along the risk curve into another higher risk asset. And that's essentially one way it works. Another way it works, which is a parallel channel that can be more important, is, if you like, more of a risk-taking channel. And this, we put a lot of weight on this. And this basically is saying is if the central bank is creating extra liquidity in the economy by whatever means, it could be lending directly, it could be buying treasuries, it could be discounting bills, whatever it may be. But if the central bank is expanding liquidity in the system, the odds of default are lessened. In other words, systemic risk is coming down. And if systemic risk comes down, then investors generally will take more risk in asset markets. They'll move out along the risk curve. So basically what you can think of is as liquidity gets pumped into into financial markets, investors move along the risk curve into higher risk spectrum of assets. And that's effectively the transmission mechanism. Now, well, actually then there'll be a further iteration at some stage, and that will cause the real economy to fire up. So the money will spill out into conventional monetary aggregates, M1, M2. Banks do more lending for capex or whatever it may be, and then you get a stronger real economy. So that can be a corollary, or it may be that the wealth effects from asset market rises cause consumers to consume more. So there are clear multipliers that emanate from that original central bank expansion. So that's how the transmission works. Okay. The second thing you ask is, how does the central bank do this? What are the mechanisms that the central bank can operate through? Well, there are many, but essentially what you've got to distinguish is not just the assets and the liabilities side of the central bank balance sheet, but also which elements are liquidity creating. And that's a very important distinction. Now, this is pertinent in the current environment because the Federal Reserve has gone on record, and we know it's operating a QT policy. So it is quantitatively tightening, by which it means it's shrinking its balance sheet. And to do that, it is basically allowing treasuries to roll off. So in other words, it's holding the treasury bonds mature and they're not replaced. So effectively, the balance sheet shrinks by that mechanism. Now, the problem with that statement is that those assets are only partially liquidity creating. And there are other elements on the balance sheet which basically affect the size of the balance sheet that don't create liquidity. In actual fact, they absorb liquidity. And the two most prominent ones right now are the Treasury General Account, which I'll explain in a second, and the reverse repo pool, which is the second thing that I'll explain. Both those two elements are liquidity absorbing, and they prevent an expansion of liquidity traveling into the money markets. So if you want to understand how much money the central bank, or how much liquidity the central bank is injecting into in this case, American money markets, what you've got to think about is the size of the balance sheet minus the reverse repo tranche and minus the size of the Treasury General Account. Now, the Treasury General Account, by definition, or for definitional purposes, is essentially the US Treasury's bank account, deposit bank account, are held at the Federal Reserve. So it's just like it held a bank account at Citibank or JP Morgan, but it's holding it at the Federal Reserve. So any receipts from tax revenues or expenditures that are made for transfer programs or infrastructure payments or whatever it may be, basically come out of that balance sheet, out of that balance of that account, and the account will change. It will move up and it will move down accordingly. At the moment, it's about 500 billion US dollars. Okay. The second thing is the reverse repos. Now, reverse repos, as the name suggests, are the opposite of repos. Think of a repo as a collateralized loan into the market. Okay. So a repo is liquidity creating, and a repo will basically mean that the Federal Reserve in this case will lend to, let's say, a dealer bank in the US against collateral, and that collateral may be a treasury security. Okay. In the case of a reverse repo, the Federal Reserve is doing the opposite to that. It is actually taking money out of the system, and it is providing it's collateralized against its holdings of treasuries. Now, the point about that tranche is that has grown very quickly and very sizably to withdraw a lot of liquidity from US money markets. And I'll explain why that's occurred in a second. But effectively, that pool has grown from virtually zero, maybe 2 and a bit years ago, to now about $2.5 trillion. So in actual fact, if you look at the math behind the balance sheet movements in of the Federal Reserve, the Federal Reserve's balance sheet this year has actually fallen by a few percent. It's probably 3 or 4%, really nothing. Okay, they've allowed treasuries to roll off, but nothing like the sort of numbers that were once being floated. They may well accelerate. Who knows? That's possible. But at the moment, they haven't really done very much on letting treasuries run down. What they have done is that the Treasury General Account has fluctuated through the year, which has changed effective liquidity creation. Use the word effective here to make that distinction. Yeah. And secondly, reverse repos have climbed dramatically to withdraw a lot more liquidity. So if you look at actually what's happened, whereas you might say a few hundred billion on paper seem to have been taken out, effectively, the Federal Reserve has shrunk its balance sheet by nearer $1.5 trillion. So actually sizably more in effective terms because of these other two elements.
Got it. And I think that was a phenomenal explanation. And on that note, so the typical so what a lot of people look at the reverse repo numbers for is, and they say that this is banks and other institutions parking their excess liquidity. Is that sort of a correct assessment, or are they sort of being forced to do it?
Well, they're not necessarily being forced to do it. I mean, the thing is that there are very few places to put this excess liquidity. That's really the point. And I think what you've got to go back is to look a little bit at the history here. Now, the history was that to go back to the COVID crisis, that recent history, is that as we know, as a result of all these transfer payments, what you saw was a huge amount of money ending up in US retail bank deposit accounts. Okay. So the US savings ratio went up, and the corollary of that was bank accounts were very flush with cash. Now, a lot of that money actually spilled over into money market funds who were giving a more attractive interest rate. And the money funds are very constrained about where they can actually put that money. So they basically have to put it into government paper, government-backed paper in many cases. Okay. Now, conveniently, during the COVID crisis, the issuance of bills as opposed to coupon treasuries shot up. So in other words, the federal government was paying a lot of its bills for expenditure by issuing treasury bills, short-dated bills, up to 3-month maturity, and continually rolling that pool, rather than issuing coupon debt. So, for example, 10-year or 30-year treasuries.
Yeah.
Now, that worked because basically the money funds, the money market funds, were then being able to invest in the bill market because there were lots of bills. But as soon as the COVID crisis ebbed away, what you saw was the Treasury returning to coupon issuance and reducing their bill supply, and therefore the money funds had nowhere to put the money. And they were forcing down rates at the front end of the term structure, which basically contradicted what the Federal Reserve was trying to do with its interest rate policy. So to basically, if you like, smooth the curve or to get rid of this anomaly, the Federal Reserve started to offer reverse repos, and the money funds flooded their cash into those areas. And that basically renormalized, if you like, the interest rate structure, but it left the legacy on the Federal Reserve balance sheet of the reverse repo tranche. Now, to say that it's a sign that there's lots of liquidity in the system is a little bit disingenuous, to be fair, because that money, that reverse repo, has actually been taken out of the system. It's a withdrawal of liquidity, and that is one of the reasons that you've got a liquidity tightness in the US. And you're seeing that liquidity tightness spill over into the Treasury market. Now, the fact that you've got liquidity problems in the Treasury market, the most important asset in the world, in world financial markets, is a wake-up call. And the Federal Reserve are alert to this. Look at how much the markets got spooked when there was the gilt problem in Britain, when gilt yields spiked, right? That has been a wake-up call to central bankers everywhere and Treasury officials, because what you do not want is the sovereign debt markets derailing. And therefore, they've started to row back a little bit on this QT idea. Now, herein is the interesting point to debate. And in the US right now, there is an ongoing deliberation about what the Treasury will do in the future to try and improve the liquidity in the US Treasury market. A lot of measures, we have metrics which show that Treasury market liquidity has fallen dramatically. Bloomberg do a daily index which shows the exact thing. Treasury Secretary Janet Yellen has voiced concerns about liquidity in the Treasury market. And I think only last night, Leigh Brainard made similar comments, that this is really on the agenda. Now, the Treasury is looking into Treasury buybacks. Treasury buybacks are a way of trying to cure the problem, but it's slightly technical. So what they will be doing is they'll be buying what are called off-the-run treasuries. So in other words, existing treasuries in the market, and replacing them with on-the-run treasuries, which are always deemed to be more liquid by market participants. And that's a technical way of improving it, but it probably isn't a sort of great solution at the end of the day. The other thing the Treasury are exploring is increasing bill issuance substantially. And that's what I think they will end up doing. So I think what you're going to see in 2023 is a substantial increase in the proportion of Treasury debt that is bills or bill issuance as opposed to coupons. So there'll be actually less coupons issued next year than originally being slated. Now, why is that important? Because what it will mean technically is that liquidity, effective liquidity in the US money markets will start to improve again. Or to put it another way, bank reserves will be underpinned and may even rise. And that's something that is normally a pretty good heads up to a stronger stock market and stronger asset markets. Now, the $64,000 question is, will the Federal Reserve call that QE? I doubt it, right? They're going to keep saying, well, of course, we're doing QT still because we're letting our treasuries simultaneously roll off the balance sheet. So they can have their cake and eat it at the same time.
Got it. And so, interestingly, you bring up the point about bank reserves. And so, you previously mentioned that, one of the ways and sort of the common, sort of the consensus view is that, usually banks, quote unquote, exchange these treasuries for reserves from the Federal Reserve. And then eventually they lend out against these reserves, depending on what the reserve requirements are, et cetera. One of the things that we've seen is there's been a proliferation of the total number of reserves in the U.S. banking system, especially post 2008. And from this 2008 to 2020 period, what I find interesting is the rate of growth in loans and leases is lower than what it used to be prior to the GFC. So when it comes to bank lending decisions, what are the different factors that drive it? Because one of the commonly known ones is the net interest margin. But what it appears to be is that even with, say, a positive net interest margin, banks are not necessarily incentivized to lend, and this sort of leads in sort of a circular loop where if banks are not willing to provide credit to the economy, there's no economic growth, and that further sort of dampens bank lending, and it sort of ends up being a self-reinforcing loop. So when it comes to bank lending decisions, how do you think about that? What are the drivers of bank lending?
Well, I think this is a absolutely key question, and it's something that I'm not going to profess to have the answer to, but I think it's one of those things that needs to be much more widely considered. And if you look at the situation really over the medium term, but particularly looking into the future, what you've got are hugely negative demographic pressures on most Western economies, including the US. The US is less affected than elsewhere, but it is still affected. And what it means is that GDP, the underlying trend in GDP growth is basically faltering. It's coming lower because one of the factors that drives the trend in GDP growth is labor supply growth plus productivity growth. Now, we know that productivity growth is challenged by itself, but you're now starting to see substantially lower labor supply growth. Now, in the case of the US, it goes down to small single figures. In the case of Japan, it's negative. In the case of Europe, it's probably negative too. So what you've got is a very significant change in the economic regime. Now, in that situation, growth stumbles. And what central bankers have traditionally done in that environment is to cut interest rates. The problem with cutting interest rates is that lower interest rates don't necessarily stimulate investment. What they do is they encourage debt. And what you've had through this period of very low interest rates is a huge growth, as we know, in debt worldwide. Debt GDP ratios have gone through the roof. Now, the problem with debt is that excessive amount of debt transforms the nature of financial markets. And it means that financial markets are no longer capital raising mechanisms, as of course the textbooks tell us they are. They're basically they're refinancing mechanisms, capital refinancing mechanisms. And effectively what they're doing most of the time is rolling over the debt that's maturing. So if you've got 300 odd trillion of debt worldwide, $300 trillion of debt worldwide, with an average maturity of about 5 years, you're talking about 60 to 70 trillion a year, which is needed to be rolled over. Now, if you think about that pool, 60 to 70 trillion, and you compare it with how much capital markets are required to finance new investment, you're talking of a figure of near 10 trillion. So the amount of rollovers compared to new financing is about 7 to 1. Okay, that's not what the textbooks tell you, and it's not how central banks manage their economies. So if you're going to refinance that debt, what you need is liquidity. And therefore, in these situations where central banks need to control inflation or control the business cycle through jacking up interest rates and tightening liquidity through QT means, they are destroying the mechanism for actually rolling over debt. So what you get are debt crises or refinancing crises. And if you look back over the last 2 or 3 decades, what you find is increasingly we face these refinancing crises. And so what you're looking at is basically an inherently fragile Western financial system because it's sitting beneath this huge pile of debt. And what we need to do is to get the debt down. The only way you get debt down is to basically have higher interest rates. And one of the problems with that debt is that the debt ultimately crowds out good capital investment. And if you need the capital investment for your productivity growth, then you can see why there's a vicious circle downwards here.
Got it.
Low interest rates are not good.
So to sort of reinstate what you said, so about 70 trillion of what capital markets are used for is for refinancing, and only about 10 trillion is for new fixed investment.
Correct.
That's
correct. And that needs to change.
That is quite crazy. And one interesting thing that came up was one of the things that banks are sort of accused of is quote unquote window dressing their balance sheets, making them look better, etc. When it comes to say quarter end or especially say year end or window dressing of balance sheets by global banks, how does that affect the liquidity, especially as it relates to the US dollar?
Well, it's complex because it can actually work both ways depending on where their assets and liabilities are. And what it tends to do is create volatility. But I would say, in the short term, what you're likely to see is at the end quarters, given the environment we're in, you're likely to see a withdrawal of liquidity or less liquidity. In other words, banks are going to sit on the liquidity. They want to hold it on their balance sheet for window dressing purposes. And they'll probably try and accumulate dollars. So the dollar may have another upward move. That's possible. But I think that, I want to put that in context because, our vision, if you like, of how economic policy is unfolding this year and next year is that this year is all about getting the Federal Reserve balance sheet down and getting the US dollar up. So the dollar has been weaponized. It's clearly a policy tool, and it's acting as a wrecking ball, as we know. Next year is the reverse of that. It's about getting the balance sheet up and getting the dollar down. And that's how I think you can compare 22 with 23. There's a difference.
Got it. And so let's move on and talk a bit more about what's going on in markets currently. So one thing that I wanted to start off with, and that you noted a few minutes ago, was sort of the gilts crisis as they related to pension funds in the UK. And one of the interesting things that we saw was that the BOE, which was sort of pounding on QT, reducing inflation, etc., once faced with the systemic risk of pension funds potentially blowing up, they immediately switched to QE, started purchasing gilts in order to sort of stabilize the market at least a little bit. So one thing that I'm curious about and to get your thoughts on was, one, did the BOE know about those systemic risks as they relate to the UK pension fund industry, and then decided to ignore it, or did they sort of not realize that at all? And then two, where else are there sort of unappreciated systemic risks in the market today?
Okay, well, the first thing to say is that just to correct the narrative, it wasn't that pension funds blew up. It was that LDI schemes, which are basically duration overlay programs for a pension fund, which sounds a wonkish concept, but I can explain that, basically derailed. And the reason for that was that they were short of margin in an environment where volatility in the market jumped. Now, let's go back to that crisis in the UK gilt market, because it's a particularly relevant one. The error was made some 2 weeks before the UK budget, which is the celebrated trigger, and the error was made by the Bank of England not raising interest rates. The Bank of England should have raised interest rates at 75 basis points. It decided not to and went for a smaller 50 basis point move. Why they did that, I scratched my head, but that was the beginning of the crisis. So number one is, let's nail this on the Bank of England, because it was primarily their issue. The UK budget was, let's say, badly handled, but in terms of the direction of what they were trying to do, I think many economists would actually have some sympathies with their attempts. What they were effectively trying to do was to actually encourage longer term growth in the UK economy. Now, let's just look at the arithmetic of that UK budget and see how it's changed, and let's do some comparisons to look at this in context. One of the best metrics of, let's say, how viable a fiscal background is to look at mandatory spending, in other words, spending on welfare, on defense, on education, etc., on health, and subtract that figure from total tax revenue. So in other words, what we're missing out in that equation is discretionary spending. So let's forget that. So let's look at that number, tax revenue minus mandatory spending, and look at how many times that covers the interest bill on the debt. In the case of the UK, prior to the budget, it covered it 1.8 times. After the budget, the so-called, the so-called, bad budget, it covered it 1.2 times, right? What is that same figure in the US right now? The answer is that same figure is 0.8. In other words, the US has to borrow to pay its interest bill, right? Britain didn't have to do that. The figure now in the UK, after the revised budget, or whatever one wants to call it, is actually 3 times, right? So in 2 years' time, it goes to 3 times, I should say accurately. That's a huge coverage ratio, right? In other words, this is not a solvency crisis or a sovereign risk crisis. No way. It's all about interest rate movements, and it's nailed on the Bank of England. If you want to get concerned, that ratio in the US, according to the Congressional Budget Office, in 2 or 3 years' time, falls to 0.3. So the US has got a serious problem. Now, for America, let's be clear, is the cleanest shirt in the laundry. Once you start looking at other countries like Japan or Europe, whoa, those fiscal problems start to escalate. So looking through the current inflation blip, okay, and I'm firmly of the view that inflation comes down quite quickly back to where we were, the real problem that investors have got to start thinking about is this fiscal burden that has got to be financed. There's a lot of Treasury issuance that's coming, and we're going to have to be called upon to finance that. That's the big challenge. Particularly if you look at this in an international context, you say, well, 30% of those Treasury sales historically have gone overseas to foreigners, particularly to the Japanese or the Chinese.
Mm-hmm. But you know what, just to sort of push back on that. So, when you say that, the US is eventually going to have to borrow even more money in order to pay off their debts, isn't that sort of the mechanism that's been going on for a while? You mentioned that right now the number is 0.8. And sort of the argument goes that, the US dollar is sort of the hegemon of the global financial system, as the global reserve currency. And therefore, countries across the world will always need US dollars. And so, people typically say, therefore, the US borrowing or US debt is not an issue. Do you agree with that?
For the moment, yes. I think that's absolutely correct. The US is the safe asset. If you look at, let's look at the dollar in context. I said that maybe next year is a different question for the dollar, but for the last decade, you've had a perfect storm of capital inflows into the US for a whole variety of reasons. One of those is Basel III regulations on international banks, the Basel III regulations, the equivalent for the insurance sector, Solvency II. Generally, regulations have been tightened up to increase the need to hold safe assets. Many of those safe assets are actually supplied by the US, and therefore the demand for US assets has basically been trending significantly higher over the last decade. That's been a huge favorable wind for US financial markets. On the other side, you've had the Eurozone banking crisis in 2010-12, which basically stopped people buying euro securities. It pushed people into the dollar. You've had the problems in China starting in 2015 with Xi Jinping's anti-corruption drive, which led to a lot of money leaving China. And you've had the COVID crisis. So there's been a lot of factors which have really underpinned the US dollar. Consequently, you've had huge capital inflows into the US. That has pushed the US currency significantly above its trend level. And you would expect some redress back to trend. And although we think that the US dollar is trending higher over the medium term, the fact is, which you cannot escape, is that trees don't grow to the sky. The dollar at some stage has got to start to realize the effects of some slowing in the momentum of capital inflow. And that may be the case next year if the Federal Reserve is forced into easing because the US economy slows down or inflation, let's say, comes back to circa 2 to 3% quite quickly.
Got it. One of the things that I did before the podcast was I put out a tweet and sort of tagged you and said, I'm speaking with Michael Howell tomorrow, and I got a few questions from there. One of the interesting questions that came up, and it appears as if everyone wants me to ask you, is what is the role of Japanese money central banks and shadow banks in Chinese Eurodollar flows, and what is the second order implication for U.S. Treasury markets?
Well, there's a lot to unpack there. I think the first thing to say is there is a lot of talk about the euro-dollar markets, right? I think one's got to be clear about this and draw a distinction about cash flows in the euro-dollar markets, which have been curtailed significantly. Okay, so the euro-dollar markets per se are not the marginal financing vehicles that they used to be in the context of cash transactions. Okay. And that has been a deliberate policy to, if you like, reduce the influence of these markets by the US authorities, by the Treasury and by the Federal Reserve. They tried to gain control, if you like, of the dollar system again in a way that they'd lost control in the period in the run-up to the GFC. In terms of futures markets, we're talking about a different thing, okay? So there's a lot of hedging going on, particularly for treasury holdings through the eurodollar markets. And that's the role that the eurodollar markets principally have as a signaling mechanism in terms of, if you like, yield curve arbitrage. That's why I would put it. So I look at the eurodollar markets, yes, but as a marginal financing vehicle for cash transactions or cash loans, forget it, they're eclipsed, right? So that's point number one. Point number two is you raised the question about shadow banks. Shadow banks are important, and they're important in not just China. They play a role in Europe, and particularly they play a role in the US. They are not they are not growing with the same alacrity that they were in the period ahead of the GFC, or in the case of China in the immediate wake of the GFC. So they're important, but they're not really the main drivers. Central banks, I mean, I stress this again, central banks have really wrestled a lot of control in the period since the GFC, particularly the US Federal Reserve. The two key central banks in the world are the Federal Reserve and the People's Bank of China. You've got to watch those two very closely. Now, our take as to what is important here is that the US Federal Reserve largely controls the fate of financial markets, and the Chinese PBOC is really more instrumental in governing the tempo of the world economy. So if you want to know, if you like, put it very bluntly, if you want to know about the E, start looking towards Beijing. If you want to know about the PE, start looking towards Washington and what goes on in the Eccles building. That's what's important.
Got it. Yeah. And on that note, so one thing that's been interesting, and Michael Pettis has highlighted this several times, and we're also seeing sort of the bust of the property bubble. We're seeing slower domestic demand in China, partly as a result of lockdowns, etc. And in addition, what we're really seeing, for example, in China is like higher export earnings are not being recycled into higher imports. So essentially they're not being recycled into higher wages, etc. One of the interesting things that I've seen is everyone's saying that there's going to be a recession next year, and sort of your base case is that by Q1 we should be, or maybe Q2 we should start seeing QE come back, and sort of the one thing, or the one thing that hasn't really dropped just yet has been employment, which has remained relatively strong. So when it comes to that, so one, when are employment conditions, going to start to change? And two, is it finally time to start buying, is it finally time to start buying, say, US Treasuries, Euro dollars, etc.?
Okay, well, again, a few questions. Let me try and tackle these. I think in terms of the tempo of the economy, I think that's a very difficult and probably the hardest question to answer. What you're seeing this quarter is a very clear step up or acceleration in growth, and that's unusual, unpredicted, but hey, it's happening. And I think that's why if you look at cyclicals on Wall Street or wherever, or look at the German stock market, you've had some very strong rallies because of this cyclical strength, okay? Why is that cyclical strength underway? It's hard to say, to be honest, but it seems to be occurring in the US economy, and it seems to be occurring to some extent in the Chinese economy. Now, the Chinese economy is muddled by the COVID lockdowns, but it's clear to us that the Chinese People's Bank is easing policy again in a way that it has not throughout this year, okay? It is certainly injecting liquidity back into the system, and that's how they govern economic activity in China. I would believe there is more of that going on. Now, what about the potential recession in the world economy next year? And more particularly, what about the employment prospects? I think many people have jumped on the idea that it's a big recession, it's a bad recession, okay? And I must admit, I thought that may well be the case, looking at the speed and the extent to which the Federal Reserve withdrew liquidity earlier this year. I think the evidence would be, the subsequent evidence, particularly from the financial markets, would lead me to question that statement now. And I'm beginning to think that we may be lucky enough to get away with a soft landing. Okay, and part of the reason for that is that, number one, China has a big footprint in the world economy, and there'll be a serious attempts by the Chinese to actually boost growth for next year. Okay, so that's point number one. Point number two is that if you look at the yield curve, or let me be more accurate here, if you look at the term structure rather than the yield curve slope, and you look at things like the credit markets in the US, you've actually got, I think, some grounds for optimism here. Now, without getting too wonkish about the yield curve, I did a study in the Journal of Fixed Income a few years ago, which actually looked at the efficacy of the yield curve as a predictor of recession. And actually, if you look at that, take that statement per se, you could say, well, actually, the yield curve is a very good predictor of the economy. The trouble is, which one? Are you talking about the 3-month 10-year, the 10-year 30-year, the 5-year 10-year, the 2-year 10, or whatever? Actually, the answer is it depends. One recession is predicted by one yield curve spread, another recession is predicted by another yield curve, but you never know. And what that really tells you is that what's critical in terms of understanding the term structure is not only the slope of the curve, but also the curvature of the curve. And we have measures that combine the two, which basically look at both convexity and the slope. Those combined measures are telling us that it's only going to be a mild recession, okay? And I think that's, given the track record of that indicator, it's worth paying some attention to. And equally, if you look at what the credit markets are saying, okay, you've got credit spreads blowing out, but this is not a 2008 situation yet. Right? It may get there, but it doesn't look like it's so far. So I think you've got grounds for some optimism. And what's more, if you look at what corporations have been saying through the last quarter, it doesn't seem to me that anyone is really screaming that things are getting that bad yet. Okay, margins seem to be holding up. There was a statement by Nestle, the big European food company, today, which said, actually, although they've got cost pressures, they're trying to expand their margins. Now, that may not be what central banks want to hear, but that's the reality. So it seems as if corporations are in not such a bad place. Obviously, that can change. And as they say, if the facts change, one changes one's view. But it looks like the idea of a deep recession is probably now reducing in probability.
Got it. No, I think that was a terrific explanation of what the markets are expecting going forward. No, so to sort of wrap up the podcast, Michael, I wanted to ask you, so what are the most important numbers that you think, investors should pay attention to over the next 12 to 24 months?
Well, I think I suppose what I would be looking at would be the particular numbers. I mean, first of all, the paramount thing that we watch is liquidity. So where are we in the global liquidity cycle is point number one that I always ask almost every day. We put a research note out about 4 weeks ago now that said we are at the point of maximum tightness. Okay, so the liquidity cycle is at its trough. It's beginning to flick up. Okay, around this point is where you get a lot of the bad news, if you like, in financial markets. Maybe the problems in crypto are a good signal of that. Okay, so what things would I look at? I would look, number one, at the level of crypto prices. That's not encouraging people to invest in that area. It's not an investment recommendation. It's a barometer. Okay, crypto is an extremely good measure of the amount of liquidity in the system. If liquidity is going up, you will see crypto prices rising. Okay, if liquidity is challenged, you will see crypto going down. Right. So that's point number one. A second reinforcing point to look at the slope of the yield curve. If liquidity is going up, the yield curve will steepen. If liquidity is still going down, you're going to get an inverted curve still. So those are really good heads up as to where we are in the cycle. Then I'll be looking at the US dollar. I think that my view is the US dollar has turned. I think you're going to get a cyclical adjustment. I believe the trend in the dollar in the medium term is upwards, but I think that 2023 is not going to be a great year for the dollar. So what I would look at as a guide is look at the price of gold. If you've got a situation where you've got liquidity rising and maybe money moving out of the dollar, the gold price should begin to move up. So that would be another thing. And then I think a final thing to watch is to watch what's happening in China, and in particular, attempts by the Chinese to get their economy moving again. And I think that's what they have to do. The big challenge out there, the biggest challenge, if you like, apart from the fiscal issue that we alluded to earlier on, the other big challenge is how China gets growth. And that is clearly a difficult thing to ponder. My view would be, I think at some stage you've got a serious decline in the value of the yuan, the Chinese renminbi coming, and maybe the yuan no longer starts with a 7 in front of it against the US dollar. It may start with a 10. And that would have a significant effect on the world economy, but it may be what China needs. And I think one of the things to start thinking about is that China's real exchange rate needs to adjust downwards, given what's happened with COVID and US trade and technology restrictions.
Awesome. I think that was a great summary. Michael, thank you so much for your time, and thank you so much for being on the podcast. It was fantastic having you on.
Great. Thanks. Great pleasure to be here. Thank you.